You are putting your money to work. You like the financials, which has not been a great trade, and you get maybe the offset of everybody say higher interest rates are good for the banks, but slowing economy is not necessarily good for the banks.
That's right.
So why that?
So look, I think the banks are in a good situation if we continue to see the yield curve steepen. We think they've cleaned up the balance sheet. The return on equity looks really well, and from a pricing standpoint, they look cheap. I think what's interesting within the financials that we particularly like is alternative managers. So we saw one of them report today. If you look at them, they're growing at about a 20% rate. They're trading less than the S&P 500. Our view, we just wrote a report on this, is that there are about $7 trillion of assets in non-traditional asset managers. We think in the next 3 years, it will almost double.
What about the tech trade? Right, we start the show today. We're coming off of a Netflix blow up. We're watching Snap, what the implications are with higher interest rates for that trade. Are you putting any money in that area of the market or no?
Yeah, I think you have to, because I think if you look at the market right now, you want to own high-quality companies, free cash flow, pricing power, clean balance sheets. A lot of those qualities are in the tech market. And if you, to your earlier point, if you look at consumer staples versus tech, in many cases, you've got some really good blue chip companies that are actually trading at a discount to staples and have better pricing power. So we wouldn't necessarily give up on the tech trade, but I think you do need to be selective with regards to what you're owning.
You're looking at, valuations of something like a Microsoft versus a valuation of, let's say, a Procter, for example, and then coming to the conclusion that in this kind of environment that Microsoft can still work, which, by the way, those stocks are considered as defensive as some of the staples are.
Well, and I think that's kind of the point. It's interesting, though, but you're seeing some real differentiation within the market, right? If you're in a situation where a FANG stock is down 60% for the year and the overall market is only down 6%, you're really seeing some differentiation between the higher quality companies and the lower quality companies that are going to struggle in this new regime.
Yeah. And the FANGs, like, you don't take any caution, let's say, from a Netflix on what that could mean for some of the other FANG stocks. I almost feel like a Netflix shouldn't even be in that conversation anymore anyway, that the Apples, the Googles, the Metas, the Microsofts are now their own category. And as long as they hold up, maybe your market, prognostication of 4,400 is okay. If that rolls, that problem.
Right. No, and I think that's a good point. I don't necessarily think you're going to see kind of these broad-based trades as much as now these really focuses on individual companies and what they're doing. So I don't think you want to just look broadly based with regards to tech or financials. You really need to understand what you're owning and what the quality of the business is going forward.
Quickly, healthcare, another area that you like.
We like healthcare. We like the defensive nature of healthcare. There's also some good growth characteristics in there. It's been beaten up. It's trading at a big discount to the S&P 500. I think that's definitely someplace to be looking to add to exposure to.
I appreciate you coming here. It's good to see you in person.